Just 8 months ago, I posted housing market stats showing that cash flow was all but dead and that time was running out for buy and hold real estate investors. Well, the tables have turned and turned fast as real estate investing's comeback story this year unfolds. And now time is running out for an entirely new group of people. And this time it is very unlikely to change direction, as the long-term implications of these market shifts will play out over years, not months. And I'll tell you who, why, and where. Let's go. EpicBreakthrough.com is the creative financing breakthrough real estate investors are looking for. Get started with a list of 21 creative financing terms and deal structure templates to invest in real estate using more of your mind and less of your money. Epic is changing the game. Start now for free at EpicBreakthrough.com. Hi, my name is Matt Theriault, CEO of Epic Real Estate, where we show people how to invest in real estate so they can escape the daily grind and retire early. The secret to retiring early, what they don't teach you in school is, rather than focusing on saving money, focus on streaming money. In real estate, we call that cash flow. Cash flow specifically is when a property rents for more than the mortgage payment costs. Investing in properties like these has set more people financially free than anything else on the planet. But it has become more and more difficult to find over the years, and as of just 8 months ago, had downright become extinct. So much so that I shared right here the last half dozen or so regions where it could still be found. And time seemed to be running out for the cash flow real estate investor. The market, however, has done an about face, driving rents through the roof, well above mortgage payments, something that nobody saw coming. Now, that would be welcomed news as a second chance in overtime if you're in the market for income property. But the clock is speeding up, and time is running out if you're in the market to rent your primary residence. And it can be credited to 5 unique trends that are unlikely to let up, and there are 10 markets right now where it's hitting especially hard. So let's take a look. According to Apartment List's national rent estimates, prices jumped over 11% in the first half of 2021, more than doubling the rate of inflation and more than tripling the typical rent growth measured in the several years preceding the pandemic. In smaller cities like Boise, Idaho, Bend, Oregon, and Spokane, Washington, rents are up more than 30% since last March. Here's why. 1, there are more households competing for homes than ever before. The early months of the pandemic saw more people moving in together to living under fewer roofs, where within just 3 months, we lost nearly 2.5 million households. Mostly young adults moved back in with family as they waited out the pandemic. And this contributed to the dramatic rent drops that just swept across the country's expensive cities last year. It was a short-lived trend, however, as households reformed almost as quickly as they broke apart, to the point we've reached a new high of just over 131 million. 2, home ownership is becoming prohibitively expensive. The supply of homes for sale and their affordability were both worsening in the years leading up to the pandemic. But this trend, it accelerated in 2020 through 2021 when new home construction slowed and wary sellers pulled off the market, resulting in a 48% drop in inventory. This imbalance of supply and demand has caused home prices to surge above affordability for most people. But as the average household net worth grew during the pandemic, credit scores rose and consumer debt fell, and although sales have slowed down a bit, there is still plenty of demand and buying power to push the market even further. I know, crazy, right? And this impacts the rental market because as supply shrinks and prices soar, more and more relatively high-income households are unable to find for sale housing that meets their needs and preferences. These households, therefore, remain in the rental market, where they put additional pressure on affordability. If not for the prohibitively high prices, they might otherwise buy homes and take some pressure off the rental market. Number 3, search data suggests many renters are actively looking for a new home right now. This chart here from Google Trends, it shows the popularity of the keyword apartments for rent over the past several years. The purple line that you see there, that represents this year, 2021, and it's well above previous years. Google Trends data stretches back to 2004, and the all-time peak for apartment hunting searches occurred just a couple months ago in July. Number 4, apartment hunters are searching with increased urgency. Apartmentlist.com measures this through their registration flow when asking about their client's urgency to move. And this chart shows that the urgency to move has hit their all-time high since keeping stats in 2019. On average, high urgency movers are searching for a new lease that starts in fewer than 30 days, which causes a more competitive market that drives up prices. And 5, apartment vacancy rates are historically low. Vacancies are disappearing. Property managers are having little difficulty filling the empty units that remain. While rents are up more than 11% in 2021, vacancies have shrunk by 36%. This month, only 3.8% of units in this sample sit vacant. With the national apartment rental market shaping up how it is, renters have no choice but to start looking at single-family homes to rent, as they account for about 1/3 of the nation's rental inventory. So where are the best opportunities for single-family cash flow investors? And where is time running out for those looking to rent their houses? Well, according to Zillow, the typical rent payments were higher than mortgages in 33 of the nation's 50 biggest metros. So the top 10, it breaks down like this. Number 10, Detroit. A difference of $268 between the typical monthly rent and the typical monthly mortgage. Number 9, Oklahoma City. A difference of $279. Number 8, Charlotte, a difference of $290. Number 7, Orlando, a difference of $314. Number 6, Indianapolis, a difference of $331. Number 5, Tampa, a difference of $384. Number 4, Birmingham, a difference of $403. Number 3, Atlanta, a difference of $424. And the biggest surprise on this list to me, number 2, Miami, a difference of $522. And finally, of which was of little surprise, drum roll please, number 1, Memphis, a difference of $556. There are a few indicators that signal this summer's rapid rent growth may be starting to cool off, but that is typical as we enter the fall. Vacancy rates appear to be bottoming out while prices are still going up, albeit slower. The resumption of evictions may further reduce price pressure by opening new vacancies, but not likely as previously and very recently demonstrated right here in a deep dive on this subject. So a brief cooling period this winter is unlikely to reverse much of the dramatic price gains that we are witnessing this summer. Rents going into 2022 will assuredly be higher than they were going into 2021. One factor that remains undetermined is how residential construction will respond to the demand of millennials, the nation's largest generation, aging into their prime home buying and single-family home renting years. In a nutshell, the American housing market is currently undergoing a supply and demand crisis, and it's a trend that shows no signs of letting up. So, where do you see the best opportunities for yourself? Let me know below. And who else do you know that needs to see this? When their name comes to mind, please share it with them. Oh, and if you are already subscribed, I pulled this video out special for you to watch next. Otherwise, I'll see you next time. Thanks for watching. Take care.